Hi, I'm Shay Russell, and today I'm here with Maurice from Proven and Probable. Now, Maurice, can you tell us exactly what Proven and Probable does?
Thank you for having me, first of all. It's an honor and a delight to be here. We have a dual-pronged approach. We're a U.S. media company, and what we do is we interview the most respected names in the natural resource space. And what we also do from there is we identify undervalued junior mining companies. So it's a dual-pronged approach in that regard, and then we also, we're licensed representatives of physical precious metals through Miles Franklin Precious Metals Investments. So we don't just talk the talk, we walk the walk. And not only that, we subscribe to the thesis of Mr. Rickards. You must own physical precious metals, and so we're deeply entrenched in the metals.
Now, one thing you mentioned before when we were talking about precious metals, you said we're advocates for the constant, not the variable.
Yes.
It sounds a little complex, but let's elaborate on what that really means.
Well, the constant is money. Money is physical gold, physical silver. And people tend to use money as a sophism when they're referring to currency. And if a sophism is simply a lie that you've been told over and over again until you believe it's true. And so we tend to think that we have money in the bank and that you put money in the stocks and bonds, you put currency. And they are the variables because currencies, over 725 currencies have been created. They all go to a value of zero. I was born a German citizen. Now, in Germany, when I was born, we had the Deutschmark. Try to purchase something now in Germany with the Deutschmark. You can't. That doesn't mean life stops, but the constant is that gold is on the periodic table of elements. It's 1 ounce of gold. It doesn't change. In essence, it is the ultimate store of value.
Okay, so let's expand a little further on your thesis and what you do for your subscribers. Anomalies and distortions. Now, we had a fascinating chat about what this actually means. So when we think of precious metals, we think of gold and silver, and a lot of people don't push past that. But you have this theory of anomalies and distortions, so let's expand on that for Australia.
Well, first and foremost, precious metals, there's really 5, but we tend to know mainly gold. But there's gold, there's silver, there's platinum, palladium, and rhodium. And there's anomalies and distortions when you look at the price ratios between the two. And right now we're seeing that because you're seeing that how many ounces of silver does it take to get 1 ounce of gold? And it's in the 80s, 90s. That is an anomaly and distortion in the market. When was the last time you saw platinum below the price of gold? It's usually at a premium to gold of 30 to 70%. It is now the opposite. And so what I like to do is I'm a strong advocate for having all 5. I know Mr. Rickards is strongly favoring gold, and we do too. But what we do see is that we can use that distortion to our advantage. And so what I'm personally advocating, and what I shared with you the other day is that 2 years ago at this very conference, we were advocating to purchase rhodium. Why rhodium? Well, rhodium a couple of years ago was $10,000 an ounce. It is, at the time, it was $800. Rhodium today, 2 years later, is $3,600. What I'm able to do now is sell my rhodium, not for currency, the variable. I trade it in for platinum, which is still the same price as it was 2 years ago, $800 an ounce, and get 100 ounces of silver. And as those ratios change in comparable to gold, then I'll now get more gold as those ratios change. And the numbers that I'm looking for an example, if someone's listening and is interested in this concept, is when it takes 54 to 45 ounces of silver, that would be a time to look at liquidating your position in silver and getting ounces of gold. But I'm never liquidating my position to get currency. And if I can give one more caveat, precious metals to me, they're insurance. And it is a ultimate store of value, and it's also my savings account. And so I value my savings account for my family in weight, in ounces. So I don't really care. I'm more or less agnostic to where's the price of gold heading. I'm looking at the ratios between those metals, and I continue to accumulate in this process. It's accretive. In about a 3 to 5 year process, you can basically, with the same purchase you made today, you probably could increase your savings account by 30% by never adding another currency note to purchase more ounces. You're just using the ratios to your advantage.
So what you're simply doing is you're telling people that you're nimble and you look at the ratios across 5 different precious metals, which is not as hard as it sounds, and you're moving when the ratio favors moving into an alternative precious metal.
Absolutely.
How did you stumble across that concept?
One of my mentors is Bob Moriarty, and he's the founder of 321 Gold. And Bob Moriarty, by the way, has introduced me to the value propositions in Australia, where you are. I've been to Karratha, and I'm proud to say that we have a sponsor there in Novo Resources. But Bob Moriarty is an author, and he's one of the most respected names in the natural resource space. And he proposed that idea to me, and I've run with it. I have run with it, and it has produced fabulous results.
All right, so let's just say for the Australian audience, you've been out to Karratha. Not a lot of Australians have actually been out to Karratha. So what were your first impressions when you got out there?
Oh, I thoroughly enjoyed it. It was a surprise to me to see that this was actually a very modern city. It had all the amenities that you could look for, good family living, but more importantly than that, I guess, or equal to that, is the value proposition that's in the ground there. Australia, you have some wonderful gold, and I'm proud to be a shareholder in Australia. We also actually had a second sponsor there as well, NX Gold.
Yep.
They're both in the Karratha, and the value proposition it's kind of unique. Usually wherever you are, you don't realize what you have. It's an outsider that realizes it. And I'm foot stomping to you. There's enormous opportunities in nickel and gold and copper in Australia.
No, that's actually a very good point. It's not so much that Australians aren't familiar. It's not, we don't know what's in the ground. It's the fact that Australians don't have a great relationship with precious metals, regardless of what our resources are. And that's what we're trying to do here. We're trying to change that conversation. So let's just say we're talking to the ordinary Aussie who's never heard of this idea of investing in precious metals, what would be a great metal to start with?
It depends on one's age. And I would say this as well. If you're looking for the more conservative metal, it's the ultimate store of value. I would say gold. It has to be gold. But all of the 5 precious metals, they're unique because they're precious, they're industrial, and they're strategic. But gold is expensive to most people. And so you could still own a metal that has those 3 variables in it in silver. And a 1/10 of an ounce of silver is very inexpensive. Even in Australian currency, less than $2 in Australian currency, you could own silver. It's not a difficult proposition. But if you look at the richest nations in the world, what do their central banks have? They have money, which is gold and silver. Third world nations don't have that. When you look at the 1% and people are advocating that the rich have all this money, their vocabulary is incorrect. The rich have the money as in gold and silver, but their concept of money is still currency. And you don't have to put the whole house on it. It's there to protect the house as insurance. As Mr. Rickers would advocate, no more than 10%. But yes, silver, and if you're looking for a silver right now, platinum.
So essentially you're saying is the start of the conversation to moving into precious metals is removing the idea that fiat currency is money and that gold is actually money, and fiat currency is simply just that, just a medium of exchange.
That is correct. I'll add a caveat to that. So when I was leaving Karratha and I was at the Sydney airport, I was at the foreign currency exchange. And if you ever notice at the foreign currency exchange, why does it not use the word money?
Oh, I've never noticed that.
I took it a step further and I asked them, can you please show me on the Australian currency where the word money is? And I went to about 4 or 5 currency exchange counters, and they all looked at it and said, I didn't know that. And then I asked them, well, then why do you call yours money? Because it seems like when I'm in Vancouver, as we are today, the Canadian citizens call theirs money, and they would call mine U.S. currency. And the moment I go to Seattle, 2 hours south, we would say the Canadians have currency and we have money. So the citizens are not aware, but they believe that that citizen of that nation believes that they have money and everyone else has currency. No, we all have currency. And you should.
Today I am joined with a Swiss-based investor, Claude Bejet. Claude, thank you for joining me.
Well, hello. It's a pleasure to be talking to the other side of the world.
Now, Claude, I want to get started with something quite exciting today, and that is gold, but priced in Aussie dollars. Now, in the last couple of weeks, gold is actually trading at all-time highs in Aussie dollars. Now, I know you've got an Aussie dollar gold price chart handy there, so I want you to take us through the technical analysis you've got, but also, too, what these new highs mean for Aussie dollar gold investors.
Well, it really means something absolutely stunning, is that you Australians understand and can act on the fact that you understand that this is a bull market. The definition of a bull market is when you're doing higher highs. So done that again, it means you know that it's a bull market, and you should take advantage of that. So that's the bottom line. The chart speaks for itself. You've had a huge run up since 2000 to the highs of 2011, and then there was a correction from 2000 to 2015, and now you're back on the main trend. So go with the trend.
So basically, Aussie gold investors are lucky that we've essentially got sort of key warning that gold is in a bull market before, based on our currency.
Yes, exactly. Because if you look at the price of, you see, everybody is focused on the price of gold in US dollar. I think they're making a major mistake. That's why you have an advantage. Why am I saying that? Since the beginning of the year, gold has been making new highs in 72 currencies. So if there's one currency that doesn't confirm, like the dollar, it doesn't really matter. We know it's a bull market. So what is going to happen, in my view, is that if you look closely at the chart of gold in US dollar, you've had a huge basing pattern that has lasted basically from 2013 to 2019. 6 times gold in US dollar has tried to go above $13.50 or $13.80. 6 times it didn't work. So you had the first attempt in mid 2013, a second attempt early 2014, then mid 2016, then late 2017, then early 2018. This is very important because it means today very few people are invested in gold. But the minute we will go through this huge technical pattern, the game will be totally different, and you're going to see a stellar price performance of gold in all currencies.
Now, before we move on to the next thing, I just want to come back to what you've just mentioned with the US dollar price gold. Now, in our initial correspondence, when we were trying to organise this interview, you made an off-the-cuff comment about how gold was due for a breakout, and you even picked May as the month. And then gold actually did break out. It rallied 3.5% in the last couple of days of May. So how did you pick this? And is this, the next leg of the bull market?
Yes, I believe this is an exciting time, and we're going to break out. So now is the time to be fully invested in gold. Look, I've been involved in the gold market since the 80s. I bought my first gold stocks when the South African gold mines were yielding 10%. So I have unfortunately a little experience with the gold market, and as you can see, I have a couple of scars on my face, so I've learned a few things. So basically, one of the reasons why people don't like gold is that it's a very unusual animal. In other terms, there's no set rule. There's no correlation that works all the time. So it depends on the fashion. So you've had periods where gold was trading with the oil price. You had times where gold was very highly correlated with the inverse of the dollar. You've had so there's or expected inflation and this and that. The reality is that gold is a complex animal, and you shouldn't rely, and indicators do change here and there. So, and then there's, of course, there's sentiment and the price action. So I wouldn't get, it's not necessary to be too complicated. Just go with the basic chart pattern. And now we're breaking to new highs. We're going to break in US dollar, and we're going to make a killing. So this should pave the way for gold to go to $3,000 or $5,000 an ounce. I don't know, but much higher.
I like your thoughts there. All right, so what we're going to move on now to is the big picture for gold. And part of this big picture for gold, as we've just talked about, is obviously the technical data right now. But there's also this persistent political instability in the globe. Now, in Australia, we're very aware of the trade war. Hi everyone, I'm Shay Russell, and today I'm joined here by Bron Suchecki, the precious metals investment analyst over at ABC Bullion. Bron, thank you for joining me today.
No, it's great to be here.
Now, Bron, you're probably going to be what I'm going to call a sort of a bit of a hidden expert in the precious metals market. Now, you cut your teeth in the gold industry in the mid-90s. So you've basically seen gold rally through a couple of bull markets now. And I do want to get to today's gold bull market that I believe is unfolding. However, I want to take it back to when you started in the precious metals industry in the mid-90s and what was happening in the gold market back then.
Yeah, well, it's interesting because if you go back, there are quite a few parallels between the first bull market that we saw in 2000 and the lead up to that and what's happening today. So in the 90s, if you look at a gold chart going back, you'll notice that the gold market was very range bound in the mid 90s between 380 and 400. And it was at that level for a couple of years. And during that period, there was a lot of the narrative or the story that dominated the market was really central bank sales were a very big concern because central banks were in a sort of general selling mode. And I think that came about because, after we went off the gold standard, there was probably about a decade where the market was still unsure about whether central banks might go back to gold. And you might think, everyone focuses on 1971, but there was a gold commission in 1980 in the US. So the issue of a gold and a gold standard was still predominant for the first decade after Nixon sort of went off the standards. So it really, by the time you get into the 90s, you had a lot more, I think, central bankers who were younger or people that coming up in the central banks who had sort of followed portfolio theory and the idea of diversifying assets. And so I think the attitude changed around gold, where a lot of the older central bankers had moved on and you had younger people coming in and their view was that gold was just an asset and an investment. And so they were looking to rebalance their portfolio and look at the central bank holdings as if it was an investment. And so they were in this general divesting sort of attitude, and that weighed on the market. And at the same time, you had the development of a lot of hedging, or I should say forward selling by gold producers. So two of those factors really weighed upon the market, and you see the price starts really declining once it broke through 380 and then on its way down to 250 in 1999. And even then at 250, the market sentiment, you might think, well, that's like so obvious in hindsight that that's such a bottom. But, at that stage, I remember all the commentary was very much like, oh, central banks are still going to be selling, miners are hedging. And so there was still quite a bit of a despondency in the market, particularly in the professional markets, and that played on into the retail market as well. And it was only, I think, the concern of the central banks, particularly the European ones who are creating the euro, they then got together and sort of agreed to limit their central bank sales because they saw how negative this was for the market. And so that was what they call the Washington Agreement, which happened in 1999. And if you look at a gold chart, you will see this really unusual spike where it goes up to 330. And so that was what that was. It was a very dramatic sort of change. But you notice that the price then continued to grind down into 2001. So whilst the market got a boost from that sort of central bank intervention, and that was intervention on the positive side, the market still had a structural sort of negativity towards it. And so it kept falling all the way into 2001.
Now, I know one thing, as you said in one of our earlier chats, was overcoming this extreme negativity in the gold market. How do you think central bank, buying and this Washington Agreement, how do you think that countered that extreme negativity in the short term?
Well, I think what happened is that certainly whilst the central bank agreement did boost the price up, having to sell their local currency, buy US dollars, and then US dollars to buy gold is effectively the trade that occurs. In Australia, our gold trading does not affect the exchange rate, but in countries like China and India, there can be a bit of an impact in it. So I think that what you see in a lot of those countries, prices rising, is not just a strong US dollar or a weak currency. It is also a very strong domestic gold market that also provides pressure upwards on the price. And then certainly in a lot of the other currencies, again, they're seeing the same impact in the case of Australia. In those countries, it attracts retail investor interest when the local price is going up, providing a bit more demand for the market. And I think that's a factor in the support for the gold price at the moment.
Now, let's wade into rabbit holes. I want to talk about the Banking Act. Now, I believe you were one of the first people in Australia to identify a particular clause in the Banking Act. Now, I've benefited from this research for over a decade now, and I didn't know that you were the first person to identify this. So let's explain what you picked up in Part 4 of the 1959 Australian Banking Act.
Yeah, okay. Well, how that came about is that I had a client call us up and say, I heard that gold was confiscated in the US in the 30s and it was illegal to own. Was it ever confiscated in Australia? And at the time I was like, actually, no, that's a really interesting question because it's all been US. And so we contacted the RBA actually to say, look, do you have any historical information on this? And what they dug out of the archives was a press release when Australia effectively allowed gold to be owned publicly. And that little press release, which I have on my blog, and I provide you with the link, it provides a little bit of a history of the gold market in Australia. And it was, just as it was in the US, it was illegal to hold gold in Australia. And I think a lot of Western countries, when they went off a sort of domestic gold standard and went to an international standard, the domestic population wasn't allowed to hold gold. It was merely something that traded between central banks. So Australia, the US, a lot of other countries, as soon as you had gold, you had to hand it off to the central bank. It wasn't really an open market domestically. So there isn't anything special about that. But what it is that in the Banking Act 1959, there is a Part 4, and Part 4 basically says, in simple terms, any gold that comes into your possession, you need to give it to the Reserve Bank. And the Reserve Bank will pay you the market price in fiat in currency. And in practice, that was pretty much really saying to miners, as soon as you've mined gold, you've got to hand it over to the RBA. You've got to sell your gold to the RBA, basically, is really what it was effectively doing. So that was the legislation that was in place. Well, at least from that act, I think there was obviously something prior to that, but certainly from that act in 1959, and that ran all the way up until 75. Now, when Nixon went off the gold standard in the US, you've got to sort of keep in mind that he said he was off it temporarily. Okay. And as I said, in 1980, there was even a gold commission, an investigation about whether the US should go back on a gold standard. So for the whole decade of the 1980s, it was still very much a question about what was gold's role in the monetary system. It wasn't just like we went off the gold standard, that was it, and gold was never ever considered again. So at the stage when the US sort of allowed the public ownership of gold and Australia followed suit at the same time, the way that the government sort of implemented that was to suspend that part of the act. They didn't repeal that section, they just suspended it. And what that means in practice is that, and if you look at the act and the wording, it basically says that the Governor-General can merely proclaim that that section is back in force. It doesn't actually need to go back to Parliament. It doesn't need to be voted on because it's an existing piece of law. It just needs to be unsuspended. But the reason I think that it was suspended and not repealed was because there was still an open question, even in the mid-70s, about whether countries would go back onto gold standard and what was the role of gold. So I think at that stage, the government realised that there wasn't any point in restricting domestic ownership and trading of gold. But they weren't sure whether they were going to need to go back onto a gold standard. So they just thought, well, Nixon was temporary. It was only 3 or 4 years into that announcement. So let's just suspend it just in case we're not sure what's going to happen. Of course, what has happened is that they never got around to formally repealing the section. And, you can leave that open to your conspiracy theory about whether, that's deliberate because they like to have that little part in the act available that they can sort of unsuspend it and instantly take all the gold off everyone. Or it could simply be that they've forgotten about it. And there are cases where there are lots of sort of arcane bits of law that, have never been repealed and, they have silly laws that sometimes do come up and people go, but why is it, illegal to do X, Y, Z, and they just repeal it. It does happen that legislation can become dormant and forgotten about. So yeah, that is in place at the moment. It does make it a bit easier, I suppose, for a government to confiscate or make gold illegal to own in Australia, because they merely have to go to the Governor-General and say, just reclaim that part, and then everyone would have to hand their gold into the government. I'm not sure that that's really would happen, and it would be interesting to know whether, you know, that part of the Act would actually get repealed. Yeah, we'd have to see.